Hello, with me today I have David Jane, multi-asset fund manager at Premier Miton. David, thanks for joining us. Investing in 2020. 2019 has been a mixed year, a bit of a bounce back from a very weak fourth quarter 2018. So, I mean, it's all relative. The stats show it's been a great year, but longer term investors will know slightly different. Where will you be putting your money in 2020?
I think when we look at the overall background for 2020, I think it's reasonable to think it's going to be a year where interest rates remain very low. Maybe they'll be on an upward path, but I think the broad background is very low interest rates worldwide and ongoing QE. That we can know with a reasonable degree of certainty, which probably provides a very supportive environment for growth stocks versus value, probably a reasonably supportive environment therefore for the US. The big unanswered question is going to be, will the economy be further slowing or will it be re-accelerating? And I don't think we can be absolutely clear about that. So broadly, we will be supporting quality growth investments over the course of 2020.
You're talking about the interest rates and the economy, and I think there's a general acceptance that we're sort of late cycle, perhaps not end cycle, but certainly late cycle. I mean, this talk that the good times are going to end in 2020, or there were perhaps earlier in the year. Now a little bit more confidence as we near the end of the year. But I guess the question is, how near are we to recession? Are we a year away, 18 months away, do you think?
I think that's one of those great unanswerable questions in reality. I think it's now 5 years since we've been talking about late cycle. You know, people think about the economic cycles as typically being sort of 5 to 7 years, but the reality is there's no date on them. The reality is economies go through expanding periods and contracting periods, but not as determined by the calendar. So what we do know is the economy is expanding at a slower rate than it has been before. Whether that ultimately leads to a recession or not is difficult really to assess. But what we do know is recessions are generally characterized by problems in a certain industry. And it's really difficult to identify the large, substantial industry at the moment that is going to drag the whole world economy down. So there is no colossal problem in financial services, there's no colossal problem in housing market. Where is the big problem that we're going to point to and say, that's causing a recession?
Okay. So if there are no obvious signs that a recession is imminent. Regionally, certainly the US tech stocks have done incredibly well this year. Again, a bit of a bounce back from a weak Q4 18. So, I mean, the question again, can the US boom, whether it be tech or otherwise? I know it's tech driving a lot of the upside in the US, but can the US boom keep going through 2020? Election year, of course.
And election years are generally up years, you know, that is true. And quite clearly, in an environment where essentially monetary authorities are obsessed with maintaining the upward trajectory of asset markets through the mechanisms of QE and ultra low interest rates, it is reasonable to think that, you know, an overall collapse in areas which perhaps look overvalued is not massively likely. So when we're looking at the more expensive areas of the market, whilst we think, you know, other areas will catch up or they may be slow or lagging, I don't think a collapse of the tech boom like we've seen before is that plausible, actually, and particularly when it's well founded on good economic fundamentals. You know, a lot of the growth in those areas, if we look at semiconductors or the digital economy, that's ongoing real growth. You may criticize the valuations, but it's hard to deny the growth.
Looking elsewhere around the world, around the globe, Russia, India, certainly Europe, a bit of a contrarian trade through this year has perhaps grown in popularity. Russia has had a cracking year so far. The UK, again, perhaps another contrarian, sort of undervalued play. Again, which regions do you like in 2020? What do you expect to be the highlights?
I think the answer to that will lie in, as we discover the answer to the are we re-accelerating or are we further slowing down in the world economy? Because clearly if we're re-accelerating, you're going to have a favoritism for the more cyclical parts of the world economy or those more dependent on global trade. So that would guide you towards Europe and Japan. If it's continued slowdown in the environment of ultra low interest rates, the clear beneficiary of that is going to be the US, where so many growth stocks, so much quality, and is benefiting from the free money. So I think the answer to that is going to come clear. We've basically been increasing our exposure to Europe and Japan, but much more neutralising that rather than making a full-on call on them yet.
Sure. And I guess a lot of what happens in the UK is going to be sort of driven by what happens with Brexit in 2020. So assuming that there's a resolution, that level of certainty, that sort of that gives investors the confidence to invest in the country again.
Quite clearly, investors hate uncertainty, and they put an undue discount on assets where there's uncertainty, and that's really been the story of the UK for 3 years now. And it's reasonable to say that big international investors are pretty much max underweight the UK and have been for some time. It's also reasonable to say that valuations in the UK on a like-for-like basis, a lot of reasons why the UK looks cheap is its mix of assets, particularly biased towards resources and so on. All of those things are true. The UK is clearly cheap. And I think you're absolutely right. Once we get a resolution of those uncertainties, the UK's got a long way to catch up. And it would as well particularly benefit from a re-accelerating global economy as well. So quite clearly, I think the UK could have a good 18 months ahead of it once we've got through those various issues.
And in terms of investment themes or strategies for 2020, do you think there are any that are going to sort of become obvious as we move sort of into the new year?
What's become clear to me, actually, I mean, we run a very thematic strategy generally in our multi-asset strategies. So we've been following themes such as healthcare and the ageing population or new energy for a long period of time. But what's really coming through strongly, both in terms of how investment markets are behaving, but also how clients are behaving, is the overall ESG theme, which has gone from being a little bit nichey, maybe like new energy was 4 or 5 years ago, was seen as a bit nichey, a bit wacky, now has become very, very mainstream in terms of its impact on the economy. ESG is clearly coming through with the sort of power that indexation came through perhaps 5 or 10 years ago, and I think it's going to drive a lot of decisions, both on the positive and negative side. On the negative side, it's difficult to imagine those heavy polluting industries really achieving any kind of valuation that they have in the past. On the other side, clearly those companies which can be part of a positive trend are going to attract a lot of capital going forward. So I think that's a theme that we mustn't ignore.
I agree with what you say. I mean, in terms of ethical investing, and the statistics now are showing more so that you needn't give up performance to trade ethically. So is that what you're seeing now?
I think the reality, I mean, we're pragmatic investors and we will not be generally driven by any rules, but I think what you can say with a high degree of certainty is if there are more and more people seeking to invest ethically going forward, there will be more buyers than sellers for ethical assets. And in the same way as perhaps the drive towards indexation drove the outperformance of large cap stocks over a long period of time, the drive towards ESG and capital markets naturally have this feature that where there is demand, there will be buyers and the assets will go up in value. So the intentions and demands of our end customers to follow more ethical strategies will drive the success of those strategies. And so, supply, demand, price.
Yeah. And are you seeing more interest, more people asking you about ethical investments?
If I roll the clock back 3 to 5 years, it was the sort of question that came up in client meetings about once a year, if ever. Now, rarely does a client meeting go by where that subject doesn't come up in some form or another, and that's driven by our clients, end clients, so it is clearly on a lot of people's minds.
Yeah. I guess another interesting discussion that's ongoing, has been for quite some time, the discussion around active investing versus passive. Now the rise of the passives over the past number of years has been sort of quite incredible. So clearly I know where you sit on this,
yes.
But if you could sort of give us a brief discussion around the area.
Well, I mean, let's be completely honest about it. I mean, Premier Miton, we've nailed our colours very firmly to the active management mast. But I get it. If I'm an end investor, when Premier Miton, we can say, well, look at these very active strategies. We're offering real value for money, a real alternative. But there was an awful lot of money for many, many years running what you might call semi-passive or semi-active ways, where they weren't offering real value for money, and customers really demand that. So, many of our customers for the funds we run on my desk, they are blending us with passive strategies, and that is fully understandable, because ultimately by blending us with a passive strategy, their clients are getting the same amount of active as they might with a mainstream active fund, but for half the price. So this is what's driving it, is value for money, and if active managers don't understand that they've really got to offer real active value for money by running genuinely active strategies, then they won't have a future.
David, Jane, thank you very much.
Thank you.